Hello everyone, in this lesson I'm going to be covering liquidity and fair value gaps. I'll be going over everything you need to know about them in great detail, and this will be a very beginner friendly video. The first question is, let's dive straight into it. What is buy-side liquidity? And to understand what buy-side liquidity is, we need to understand what everyone else is thinking, more specifically retail traders. So if we get a sharp move down in the market, followed by a retracement back upwards, what is retail traders thinking? Well, they're thinking that this could be maybe a rising wedge pattern, or a bear flag, or maybe a retracement into some fib levels before doing what? Before heading lower. So if retail traders are selling right here, if they're shorting the market, where is a key place for them to put their stop loss at? Well, in the books, we're taught to have our stop losses above old highs. So a lot of stop losses are going to be above this high right here because retail would look at that as the invalidation point. If they're selling right here, if retail is selling, what is their stop loss categorized above this old high? What is it categorized as? Well, it's categorized as a buy stop because if they're selling here and if the market trades above here, that's where their stop loss is. So they have to buy back their position above this high. That is why above old highs is categorized as buy stops. So if we take a look at this example over here, right, we do have a kind of sharp move down in the market, and then we have this retracement back to the upside. And this looks to be a bear flag, right? We get a break beneath the lower point of it. It's retesting it as resistance. A lot of retail traders are going short in here. Where are their stop losses going to be? Well, above old highs. So above this high right here, and then above this previous high right here. So smart money and the algorithm targets those old highs so smart money can get filled on their orders, because what's actually going on here is retail is going in and they're selling because of this bear flag, thinking that we're going to see lower prices. The algorithm pulls back to the upside and it takes out these old highs. So what's happening is their stop losses are getting triggered when price takes out these old highs, and it's flooding the market with buy orders at a higher price. Now you may ask, well, why would they do that? What sense does that make? Well, it makes sense because if the market's getting flooded with buy orders, what can smart money do now? Well, they can go in and sell to those buyers at a higher price. So now they're selling at a premium, right? They're selling at a good price up here. So once it takes out these old highs, the market's flooded with buy orders. Smart money goes in there, sells to those buy orders, and now smart money's short. Now the real move can happen. So it doesn't happen here yet. It happens after we get that run on liquidity. So understanding liquidity is just pretty much understanding where is retail stops going to be. And the algorithm already knows where retail stops are going to be because we're all taught the same things going into these markets. We're told to have our stop losses above old highs, and retail traders are thinking that their stop is safe up here because we have a bear flag or a rising wedge. But what really happens is those stops get targeted. Now the market is flooded with those buy stops or buy orders at a higher price. Smart money can go and sell to those buyers up here. Now you still may be wondering, why would they do that? And the reason is because they need to get filled on their orders, right? They're trading with tons of money and they need someone on the other side of their transaction. So they develop this algorithm to where they can just take out old highs, and now what do they have? They have tons of liquidity at a higher price. Now they can go in there and slap that sell button because now there's tons of buy orders who are going to be buying where they are selling at. That is the basics of what buy-side liquidity is. So above old highs is going to be buy-side liquidity. So just for some examples, we could draw out these old highs. It doesn't mean every high needs to be targeted. That's something important to understand. But just a good exercise for you is to go into your own charts, just mark out some old highs. And if we just go over here, we could see that if we marked out this old high, right, a lot of retail traders are thinking that this is key resistance in here. We get a slight run on those buy stops. So the market takes out these highs. Retail traders are thinking, oh wait, we got to close above resistance. Now it should retest it as support and continue higher. Well, the idea here is your stop losses were just targeted by smart money. So it takes out the old highs or the buy stops, right? This is buy-side liquidity. So think of it like this. Buy-side liquidity, the only reason it's called buy-side liquidity is because buy stops rest above old highs. So the market takes out the buy stops, smart money sells to those buyers at a higher price, then we get the real move down. That is what buy-side liquidity is. That is the basics of understanding ICT concepts. You need to first understand the narrative behind liquidity, and that is what I just explained to you guys. So buy-side liquidity rests above old highs. Now let's dive into what sell-side liquidity is. So it's a very similar concept here. Sell-side liquidity rests below old lows because if retail traders, right, let's get a perspective of what retail is looking at right here. So retail is looking at a potential rising wedge pattern. They're thinking that price can start to break out here. Now, some of them may be bought before the breakout, right? Or I'm not really sure exactly who's buying where here. But what I do know is a lot of retail traders are going to have their stop beneath this low. So they could have looked at this as a bull flag as well, right? Thinking that this is just a retracement before heading higher. And a lot of stop losses are going to be beneath this old low. So if retail traders are going in and they're buying right here, right? Let's say that they're thinking that we're bouncing off of key support or just anything. Below old lows is going to be sell-side liquidity because if retail traders are buying in here, they're thinking that this is a key rejection of support where stop loss is going to be placed at. They're going to be placed right here. If retail traders are long and their stop loss gets triggered, well, they have to sell their position. So smart money and the algorithm targets these lows to create sell orders at a lower price. Now what can happen is smart money can go in there and they can slap that buy order and they can buy from the sellers. So they're taking out these old lows to trigger those stop losses. Now smart money is buying from the sellers. That's why you just see a wick this level and then reverse quickly, right? So here's another example over here. So we have this old low. Stop losses are going to be placed below old lows by retail traders. That's just what we're taught in the books. Takes out that old low. Smart money is buying from those sell stops, and then we start to continue higher. Same idea over here. We have this old low. The algorithm targets that old low. The sell stops are getting triggered. Smart money's going in and buying from those sellers at a discount, right? Continues higher. So that is what sell-side liquidity is. Here's another example. So we leave these relative equal lows right here. You have this low relatively equal to this one. When there are highs and lows clustered close together, typically there's going to be more liquidity there because retail is going to look at it as what? They're going to look at it as stronger support. So they're thinking if we get a large move down beneath this low, well, it's invalid, right? So the algorithm targets these lows. We get a nice wick below it. All of these sell stops are getting triggered. Smart money is buying from those sellers, and then they reverse it higher. And look what they leave up here. They leave these relative equal highs. So what they do is they buy from the sellers at these lows right here at a discount of the range. And what they could do now is target these highs. And what's the purpose of targeting these highs and leaving these relatively equal highs intact? Well, what they can do now, here's where it gets interesting. So they leave the relative equal highs. They target the sell stops, right? They're buying from the sellers. And now they could target above these highs because what rests above these old highs? Buy stops. So what they could do is they could buy from the sellers at a lower price and then target these highs to now sell to the buyers above these highs. Now they don't do that in this case because they have buy side liquidity that they're targeting way up higher, but the algorithm leaves these relative equal highs intact so it can utilize that run higher so smart money has the chance to cover their position above this high. So that is what sell side liquidity and buy side liquidity is. This is what the algorithm is constantly doing. It's constantly targeting old highs and old lows, or it's reaching for inefficiencies in a discount or a premium. So the next thing we're going to be talking about is fair value gaps, which is also referred to as an inefficiency or an imbalance. And we'll be going over the logic behind that. So now we will be diving into fair value gaps, and I'm going to be going over everything you need to know about them, from BISIs to SIBIs to consequent encroachment to institutional order flow entry drill. We're going to be covering it all, but we have to start off on the basics to understand that. To understand what a fair value gap is, we need to understand what occurs or how many candlesticks it needs, right? So a fair value gap is a 3 candlestick pattern. So this is candle number 1, this is candle number 2, and this is candle number 3. You'll understand why I chose those specific candles in a minute. A fair value gap, a bullish fair value gap more specifically, is when candle number 1, look at its high right here. So the high, this is the high end of the candle. A bullish fair value gap or a BISI fair value gap is when candle number 1's high and candle number 3's low do not overlap. See how their wicks do not touch here? This wick and this wick, see how it doesn't touch? And it's just the body we categorize this as candle number 2, traded in this area. This creates the bullish or BISI fair value gap. Why is this significant? Well, it's significant because the algorithm constantly refers back to this area as support when we are in a buy program. So what a BISI fair value gap is, it's a buy side imbalance, sell side inefficiency, because it creates an imbalance here, right? It's only delivering to buy side here, and it's inefficient in sell side delivery. So see how between this area of candle number 1 to candle number 3, we only get this big green area. This is creating an imbalance in the delivery of price action because it's only moving up here. It's failing to move down. It did not offer sell side. So if you're confused, I'm pretty sure if you just stick along, you'll understand it a little bit more. So look how constantly when the market's moving back and forth, if we take a look maybe at a better example up here, this would be efficient market delivery, where it's just constantly trading up, down, up, down, up, down, not leaving gaps in price. When it leaves a gap like this, it creates an imbalance, and the market is constantly creating imbalances and rebalancing imbalances. So the algorithm will refer back to this area, which ICT coins as the fair value gap. And if we're in a buy program, it can potentially act as support. Now, I will teach you in later lessons how to use this as an entry model. If you guys do want to see more content like this, just let me know down below. Just leave a comment and I'll continue this series of this ICT education. So basically, we have a buy side imbalance, sell side inefficiency fair value gap. The market retests it as support and then it continues higher. So pause the video real quick and just try and find another example of a fair value gap. I'll leave it on this screen right here. So I'm going to continue. Basically, here's another fair value gap. And the reason that is because we have this candle's high and this candle's low that don't overlap. So this creates a buy side imbalance. See how it only delivered up here? The algorithm will refer back to that imbalance. And if we're in a buy program, it can act as support before heading higher. So what would be an example of something that's not a fair value gap? Let's try and find that. So see how if we were to mark out the upper wick of this and the lower wick of this, right? These wicks overlap. So this candle's high and this candle's low overlap. There's no gap there. Here's an example of a bullish fair value gap that worked, right? Candle number 1, it's high, and candle number 3 is low, do not overlap here. See how they don't touch? This high and this low are touching here. This is not a fair value gap. So this is what a bullish fair value gap is. Let's dive into some more examples. Here's one on Bitcoin, because I know a lot of people are probably thinking, does this work in crypto or is this just the stock market thing? It works in every market. So we have this bullish fair value gap, or a BISI, a buy side imbalance, sell side inefficiency. See how price is constantly moving back and forth here? This is efficient price delivery. It's not creating any imbalances. Right here, it creates a big imbalance. This candle's high and this candle's low, or if to get in more specifics, candle number 1's high and candle number 3's low don't overlap. This is a big buy side imbalance because it creates an imbalance to the upside, and it doesn't offer sell side liquidity to the marketplace. Right in here, as we're moving back and forth, it's constantly offering buy side and sell side. Here it's not. So the algorithm, since we are in a buy program for Bitcoin, refers back to this BISI fair value gap as support before continuing higher. Now, if you would like to see me applying these concepts in action, I do have a Discord where I go over multiple setups per week and even per day, covering these concepts on a lower scale. I know that's another question that you guys may have. Does this work on a lower time frame? It works on every single time frame. These concepts are fractal because the algorithm is designed, smart money designed the algorithm to constantly seek old highs and old lows for liquidity, or creating imbalances or rebalancing imbalances. So this bullish fair value gap is considered to be an imbalance, right? Because it's a buy side imbalance. This is a bullish fair value gap. Since we're in a buy program, retest that as support and continues higher. So if you guys would like to see more content like this, where I do actually cover these setups live, I do have a Discord that I will leave the first link down below. So this is a bullish fair value gap on Bitcoin, retested as support, then continues higher. That's going to be it for BISI fair value gaps. Now we'll be going over what the SIBI fair value gap is, and this is just a bearish fair value gap. So again, it's a 3 candlestick pattern. This is candle number 1. This is candle number 2, and this is candle number 3. What we're doing is we're drawing a wick on candle number 1's low. We're drawing a line on the wick of candle number 1's low, and we're drawing a line on the wick of candle number 3's high. So from this low to this high, see how it's only traded down in here? It's only created this big candle down. This has created a sell side imbalance, and it's inefficient in buy side delivery because it only delivered to the downside here. This is a bearish fair value gap. Since we are in a sell program here, if we kind of combine the other concept, right, it took out this old high. So it took out the buy stops above this old high. Smart money goes in, they sell to the buyers at a higher price. Now they're going to distribute price down to sell side so they can cover their position, right? So as it's doing that, it creates this fair value gap, reprices to it, retest it as resistance, and then continues lower. So this is a bearish fair value gap. For another example, right here, from this candle's high to this candle's low, or actually from this candle's high to this candle's low, see how it's only traded down here? This is candle number 1, 2, and 3. Retest that as resistance, then continues lower. So let's find an example of what is not a fair value gap. So let's say this was candle number 1, right? We could draw a line on the lower part of that. And then if this is candle number 2, does candle number 3 overlap that candle number 1 low? Yeah, it does, on this big wick to the upside. This is not a fair value gap. In order for there to be a fair value gap, there needs to be inefficient price delivery. The reason that this is a fair value gap is because candle number 1, if we zoom back out, candle number 1's low and candle number 3's high do not overlap. The delivery is only down in here. It's creating an imbalance. The algorithm refers back to this area, retested as resistance since we are in a sell program, and then continues lower to sell side liquidity or sell stops, because now smart money can take out the sell stops to buy back their short position at a lower price, and then the market continues higher. That is what a bearish fair value gap is. Now we're going to be diving into what consequent encroachment of a fair value gap is. I know it's a little intimidating hearing these different terms, these different ICT terms and the lingo, but it's really not that confusing. If you just stick with me, you'll understand it very quickly. The CE, or consequent encroachment of a fair value gap, is the midpoint. That's all it is. So what we're going to do, if you go to the left-hand toolbar and you go 3 down, click on this little right arrow, the fib retracement is what we're going to be using. And some people may be thinking, I thought this was smart money concepts. Why are you using a fib? Well, just stick with me for a second. What we're going to do, if this is, actually, let's go back to the last example. This will probably be a little easier for you guys to understand here. What we're going to do is we're going to draw the fib from candle number 1's low. So from the low end of the fair value gap, candle number 1's low, to candle number 3's high. That's all we're doing. And what I like to do is turn on the magnet tool in the left-hand toolbar. So I'll just do a little weak magnet right there. And what it does is it just locks on candle number 1's low. And then I can just drag it to candle number 3's high. You see how easily it just snaps onto those levels. And then what I also like to do is just extend the line to the right. So now I don't have to move it over and mess it up at all. So the purpose of marking out the CE, or the consequent encroachment, is just to identify the midpoint of the bearish fair value gap. That's all it is. So it's not too difficult to understand. The reason that we mark this out is because this is a sensitive point of the fair value gap. So the algorithm, when it pulls back upwards, it can be sensitive to that midpoint, or the consequent encroachment of the fair value gap. So to take a look at another example right here, this is a bearish fair value gap. Now you may be thinking, well, it overlapped right there, so it's not. Well, remember, this is candle number 1, 2, and 3. Anytime that candle number 1's low and candle number 3's high do not overlap, it creates inefficient price delivery, and that is a fair value gap. What we can do, draw the fib from the swing low of candle number 1, or from the low end of that, to the high end at candle number 3. So candle number 1's low to candle number 3's high, the midpoint, that is consequent encroachment. Though it does completely reprice to the upper end of the fair value gap, so the high would be considered the upper end, or the FVG high, that's what ICT refers to it as, and this down here would be the FVG low, and then the midpoint is the consequent encroachment. So even though it reprices to the FVG high, look where the bodies of the candles respect. Well, that's because this is a sensitive, excuse me, this is a sensitive point of the order block. If retest this as resistance, then we continue lower. That is what the consequent encroachment of an order block, or what of a fair value gap is, sorry. So now if we were to apply that same idea, right, to a bullish fair value gap, let's take a look at another example over here. If we were to draw it from the, it doesn't really matter where you draw it from. You could either draw it from the high of candle number 1 to the low of candle number 3, or from the low of candle number 3 to the high of candle number 1. It doesn't matter which way you draw it, because either way, it's going to come out to be the 50% point. So I'm going to draw it from either of those points, right? Candle number 1 to candle number 3. The midpoint, or the consequent encroachment, is that 0.5 level. That's going to be a sensitive point of the fair value gap. So the algorithm reprices back to the low end of the fair value gap. Look where the bodies of the candles respect, the midpoint or the consequent encroachment. Then once we pass to the upside, this is a balanced price range now. So now we have efficient price delivery because it completely repriced, filled in the gap or the imbalance, right? And then we traded higher. Now this is a balanced price range, and the algorithm just continues to spool higher after that. So now I'll be diving into the next concept, which is institutional order flow entry drill, or IOFED, of a fair value gap. All that is when we get a partial entry into that BISI fair value gap. So if the fair value gap is from this candle's low to this candle's high, when price barely taps into it, it's just a partial entry and then reverses, that's institutional order flow entry drill. So that's a type of entry if you just want to buy it right as it trades into that fair value gap right there. But again, I'm not showing you any entry patterns in this video, because all I'm trying to do is help you guys understand what a fair value gap is and the logic behind it. We'll be going over stop loss placement and all that in a future video if you guys would like to see that. So just let me know down below. So that is all a institutional order flow entry drill is. If you ever see ICT mark out this IOFED on his chart, right? Sometimes he'll even do it beforehand. So let's say he's not expecting it to completely reprice to the low end of the fair value gap. So he's not expecting it to tap that low end right there. Sometimes he will just be expecting a partial entry into it. So if you ever see him mark out IOFED, that just means he's looking for a partial entry before price continues to spool higher. So now we're going over the last concept, and this still has to do with the fair value gap, but now we are inversing the logic here. So you can see how we do have this sell side imbalance, buy side inefficiency fair value gap. Usually this would be a bearish fair value gap, right? We have this sell side imbalance right here, inefficient and buy side delivery. The market just rips right past that. So it taps that little order block right there after taking Sellside Liquidity, and then we get a strong shift in market structure to the upside. Now, since we're in a buy program, the algorithm's going to refer back to bearish PD arrays. This is considered to be a bearish PD array, and it can use it as an inversion. So usually it would act as resistance if we were in a sell program. Since we're in a buy program, it rips above there, comes back down, retests the bearish fair value gap as support. So that's all an inversion fair value gap is. If it's normally used as support, it would be used as resistance. So to go over another example right here, this isn't really the best example, but here we do have a BISI fair value gap, a buy side imbalance, sell side inefficiency. See how price just kind of rips right past there. When the algorithm pulls back up into this bullish fair value gap, it retested as resistance. This is just as a little speed bump before continuing higher. So a inversion fair value gap, if it is bullish, right, it's used as resistance. This is a bullish fair value gap that turned into an inversion, used as resistance. Here is a bearish fair value gap turned into an inversion, used as support. So pretty simple concept here. So that's going to be it for this video. If you guys enjoyed this, please let me know down below, and I will continue this series. And make sure you subscribe and share this video if you would like to see more content. I'll catch you guys later.